Hello and welcome back to the Geordie Pig Investor channel, where we delve into the world of dividend investing to help you build a portfolio that pays you. Today's stock analysis video is all about PayPal, or as I like to call it, Pain Pal, because let's be honest, this stocks chart has been hurting investors for a while, but sometimes the best opportunities hide in the stocks everyone's given up on. I'll break down why I think PayPal's finally showing signs of life, the key fundamentals that caught my eye, and why I've decided to swipe right in and add it into my own personal portfolio. PayPal Holdings is a global financial technology company that enables digital payments and money transfers across more than 200 markets. In simple terms, it's one of the pioneers of online payments, the middleman that lets people and businesses send, spend, and receive money safely without sharing sensitive financial information. Founded in the late 1990s and famously tied to the PayPal Mafia, a group that includes Elon Musk and Peter Thiel, PayPal has grown from a simple payment processor into a full-fledged digital wallet ecosystem. It owns platforms like Venmo, Braintree, and Honey, giving it exposure to peer-to-peer payments, e-commerce checkout, and even consumer rewards. Today, PayPal's business model revolves around taking a small cut of every transaction processed through its network. Whether it's someone buying trainers online or paying their friend back for pizza, the company has over 400 million active accounts and continues to push deeper into digital commerce, cross-border payments, and even crypto transactions. As you can see on the chart, year to date they are down 21.76%, but if we zoom out and look over the last 5 years, they're actually down a staggering 63.58%, which is exactly why I want to dive deeper into the stock for you all today and show you why I think this presents a fantastic buying opportunity. If you've been thinking about getting started with investing, this is one of the easiest ways to begin. I use Freetrade, a commission-free investing app that makes buying and selling shares simple and transparent. The platform is clean, user-friendly, and you can invest in UK and US stocks without worrying about hidden fees. And right now, if you sign up using the link in my description and deposit just £50 into your account, you'll get a free share worth anything between £10 and £250. Oh, and I might add that if you're unsure what to invest that £50 into, don't worry about it. You will still receive your free share even if you don't invest that money. It's a great way to start building your portfolio with zero risk on that first step. Check out the link below and claim your free share today. Starting off with their slow growth and post-pandemic hangover. After the e-commerce boom of 2020 to 2021, PayPal's user growth and transaction volumes have cooled off significantly. The pandemic pulled a lot of future growth forward, and once spending normalized, PayPal's growth rates fell sharply, leading investors to revalue the stock at a lower multiple. You then have the margin pressure from unbranded payments. More of PayPal's growth now comes from its Braintree business, which handles payments behind the scenes for merchants but at much lower margins. Even though total payment volumes is rising, profits aren't keeping pace because this segment is less profitable than PayPal's core branded checkout button. And you have rising payments with competition such as Apple Pay, Google Pay, and Shop Pay. The checkout and digital wallet space has become crowded, with tech giants offering faster integrated payment options. So as Apple Pay and others capture market share, PayPal loses its once dominant position, forcing it to spend more on innovation and partnerships, squeezing profitability. Next up, we have the valuation reset and overpricing after 2021 peak. At its 2021 peak, PayPal was priced for perfection, trading at extremely high growth multiples. When growth slowed, the market drastically repriced the stock downward. Even if the core business remained solid, this multiple compression explains a large part of the 5-year decline. Then we have the execution concern and leadership turnover. Frequent management changes and shifting strategic focus have left investors uncertain about long-term direction. Consistency builds investors' confidence, and PayPal hasn't had much of it in recent years, making Wall Street pretty hesitant to reward the stock. And finally, we have the macro and regulatory headwinds. Broader market factors like rising rates, tighter consumer spending, and increased regulation around digital payments have all weighed on sentiment. Even well-run fintechs struggle when global transaction volumes slow and compliance costs rise, adding pressure to both growth and margins. Now let's have a look at why I think it's actually a fantastic buying opportunity. With the first one being the valuation has been crushed, but the business model is still solid. PayPal is trading at one of its lowest PE ratios ever, around 12 to 13 times forward earnings, a valuation you expect from a non-growth company, not a global fintech with strong cash flow. In my opinion, the market has overcorrected. Even modest growth or margin recovery could spark a major re-rating from these depressed levels. Then you've got the fact that PayPal is a fintech giant with enormous reach. With over 400 million active users and over 1.5 trillion in annual payments volume, PayPal remains one of the most recognized and trusted brands in digital payments. Scale and trust takes years to build, and PayPal already has both. That gives it a durable moat even as competition heats up. Then we've got the new leadership and renewed focus. New CEO Alex Chriss has shifted the company's focus towards profitability, product innovation, and streamlined operations. Leadership changes often resets culture and priorities. If PayPal can execute a leaner, more focused growth strategy, earnings could surprise to the upside. And then we've got their massive share buybacks and strong free cash flow. PayPal continues to generate billions in free cash flow and is aggressively buying back shares, over $5 billion in repurchases in just the last year. When a company is buying back shares at low valuations, it compounds long-term shareholder value and signals management confidence in the stock's future. You've then got the further growth opportunities. With Venmo's business integration with Amazon, the continued expansion of Braintree Merchant Network, and innovation in one-click checkouts all provide upside catalyst. PayPal has multiple engines for renewed growth. It doesn't need all of them to fire at once for earnings momentum to return. And finally, we've got the market sentiment feels washed out. After years of disappointment, most investors have simply given up on PayPal, and that's often when opportunities are greatest. When sentiment hits rock bottom and fundamentals stabilize, even small positive surprises can drive outsized returns. We are now going to have a closer look at PayPal on Stockopedia. Stockopedia is like a Swiss Army knife for investors. It packs stock screening, financial data, charts, and expert analysis all into one easy-to-use platform. If you're interested in trying it out, then click the link in the description to receive a free 2-week trial alongside a massive 25% off any package. Stockopedia's quality, value, and momentum scores break down a stock's investment appeal from 3 angles, and we can see PayPal scores extremely well on quality and pretty good on value. And the stock having a slightly lower momentum score actually just further confirms that the share price is currently cheap. Overall, we can see PayPal get a fantastic stock rank at 92. Below these scores, we can see in a little more detail what metrics are being used for growth and value. I love this breakdown as it shows you how a company compares against the industry, but then also against the market as a whole, which really starts to paint a picture. Another great feature is that it shows you how a company is performing when compared against the Piastri F-score, Altman Z-score, and earnings manipulation risk score. For PayPal, it scores very well across the board. They tick 8 out of 9 of the boxes on the Piastri F-score, which means the company is very healthy. We can then see on the Altman Z-score that it ticks 2 out of 4 boxes, so it's still within the safe range and it is classed as being in good financial health. And finally, on the earnings manipulation risk score, it ticks 7 out of 8 boxes, meaning that it is extremely low risk. In their most recent earnings call in Q3 2025, PayPal reported net revenues of $8.4 billion, up about 7% year over year, and total payment volume, TPV, grew approximately 8% to $458 billion, and transaction margin dollars rose about 7% year over year, showing improved profitability on the core payment business. Operating income increased 9%, and the company delivered non-GAAP EPS of $1.34, up 12% year over year. PayPal also initiated its first ever quarterly cash dividend of 14 cents per share and continued with robust share buybacks, 1.5 billion in Q3 alone, which now means it's moved up to 5.7 billion in share buybacks just over the last 12 months. Honestly, I was already really liking the look of the company, but then after that most recent earnings call, especially announcing that dividend payment, that's why it convinced me to start up a position in PayPal. And as we can see on their total revenue chart, it's up and to the right, just how we want to see it, which is very similar to their gross profit chart and their operating profits. Next up, we are going to have a look at PayPal's intrinsic value. To work out the intrinsic value of a stock, I combine two key approaches: a discounted cash flow analysis and a relative valuation using peer multiples. With DCF, I forecast the company's future cash flows, then discount them back to present value using a chosen discount rate to account for risk in time. This then gives me a baseline value based on the business's own cash generating ability. I then cross-check that with a relative valuation, looking at how similar companies are priced using ratios like PE, EV to EBITDA, and PFCF. By averaging the results from both methods, I get a more balanced and realistic estimate of what the stock is truly worth today, and when plugging in my numbers, we can see on the worst case valuation, they were valued at $70.42, which is a 5% undervaluation on the current price. On the average case, they were valued at $93.59, which is a 29% undervaluation on the current price. And on the best case scenario, when plugging in my numbers, we can see they were valued at $136.56, which would be a 51% undervaluation on the current price. I then use Wall Street estimates when analysing a company because they provide a broader market consensus on future earnings, revenue, and cash flow expectations, usually based on detailed research from industry analysts with access to management insights and market data. These estimates help me stress test my own assumptions and see if my valuations are in line with or diverging from what the market is expecting. It also gives context around investor sentiment and potential catalysts or risks that may not be fully reflected in historical data alone. In short, they help validate or challenge my thesis with a wider lens. And when looking at the Wall Street estimates for PayPal, we can see on the lowest forecast, they believe there could be a 6% downside, being valued at $66.62. On the average forecast, having a 26% upside, being valued at $84.08. And on the highest forecast, having an 89% upside, being valued at $126. And now I have all three valuations. I'll combine them to get my final best, average, and worst case scenarios to see if PayPal is trading at an attractive price. On my worst case scenario, PayPal was valued at $66.52, so with a 10% margin of safety, you'd be looking to buy the stock at $59.87, and with a 20% margin of safety, you'd be looking to buy the stock at $53.22. On the average case, they were valued at $88.84, so with a 10% margin of safety on this price, you'd be looking to buy the stock at $79.96. And with a 20% margin of safety, you'd be looking to buy the stock at $71.08. And on my best case, we can see PayPal was valued at $131. So with a 10% margin of safety, you'd be looking to buy the stock at $117.90. And with a 20% margin of safety, you'd be looking to buy the stock at $104.80. So to wrap it all up, PayPal's been beaten down, no doubt about it. The last few years have been rough. Growth has slowed and sentiment is about as low as it gets. But that's exactly why I've opened a position. The company still processes nearly $500 billion in payments each quarter, generates a massive free cash flow, and is now laser focused on efficiency and profitability under new leadership. Don't forget that on my average case price with a 20% margin safety, they are still comfortably underpriced right now. So with a dirt cheap valuation, billions in buybacks, and steady growth still coming from Venmo, Braintree, and Checkout, I think the downside is limited and the upside could be huge if execution improves. In short, while the market's focused on PayPal's past pain, I'm betting on its comeback. So PayPal might have been pain pal for investors lately, but sometimes the best gains come from the stocks everyone's given up on. With a little patience, this fintech underdog might just pay off big time. Thanks for watching. If you enjoyed this breakdown, smash that like button and subscribe for more stock insights. For now, this is the Geordie Pig Investor, over and out.